Trevor, what are your rate expectations and your Fed expectations for the rest of 2025? And then we'll talk about 2026.
Yeah, sure. Thank you, Greg. So I think the Fed will deliver another 25 basis point cut next week, and then suspect that they'll deliver yet another one in December. It's something that we've been calling for all the way back to August, is 2 to 3 cuts this year as they acknowledge the softness in the labor market and move away from their focus on inflation. And so we think there's enough sort of pervasive weakness or softness in the labor market for them to deliver on that.
All right, so what are your thoughts on duration? Where do you want to buy bonds on the curve?
Sure. So, one of our maybe out of consensus views this year has been the attractive asymmetry in the U.S. duration market. A couple things. One, going back to when 10s were at 450, 460, we talked about if you went to 5, which was sort of the bearish outcome, you could still eke out a small return. But if you got down to 375 or 4, you could deliver, 10, 11, 12%, which we thought was really attractive. And for us, we're starting to sort of creep out the curve. The front end's been the big performer this year. We're starting to move more into 10s and a little bit of 30s, which has performed very well recently.
So if the Fed is watching labor as opposed to inflation and they're cutting rates, so what is your view of the labor market? Are they doing the right thing?
I think so. And, anytime we analyze what the labor market's capable of over the next 12 months, we look at 3 things. 1, population growth. 2, the participation rate, and then 3, unemployment. And when we analyze those 3 things, for the next year or so, a big change on the population side is the change in immigration policy. So we've gone from a huge tailwind to now, frankly, a headwind there. So getting very little growth. Participation really maxed out at multi-decade highs coming out of 2022 when firms were hoarding labor to deal with COVID demand on the back of fiscal stimulus. But we're starting to see that ebb with an aging population. And then I would also say we're seeing the early signs of the influence of AI on younger workers, recent college grads, and starting to see some creep up on the unemployment rate there. And so when we look at all 3 of those components, the outlook for growth in the labor market is pretty muted. We think we can be stable in terms of the level, but the growth from here should be relatively contained.
All right, let's take a quick look overseas. What are your thoughts on foreign fixed income? Could be Europe, could be emerging markets, because their equity markets are doing awfully well.
Sure. So I would say it depends on where you are in the capital stack. And so a couple things. One, when we look at credit, one thing that we talk about when we think about equity investing is looking for growth and innovation. In credit, you don't have to have the growth, you just need stability. And so we actually like Europe as a source of income and relatively low volatility in fixed income for our opportunity set for the go forward. We still like the US, as we talked about with duration. We think there's attractive asymmetry there. And then in terms of moving up the capital stack with interest rate risk or duration, there, again, we talked about the US and what we like there, but also seeing opportunities in local currency emerging markets, places like Mexico, Brazil, India, where the currency is actually proving to be relatively stable and you're getting very attractive yield, where we think you'll also get tailwinds if the Fed continues to deliver on these cuts.
All right, you're a fan of fixed income at home and abroad, but what about private credit? It seems like everyone wants to send you or sell you bonds that aren't traded publicly lately.
Sure. So private assets and private credit is certainly, topic of conversation, really the last couple of quarters, and will be, we think, for years ahead. I would say a couple things. One, most people will probably start off with the premium that you can pick up for taking that illiquidity risk. What I would focus on and what's most compelling today, if we're getting later in the credit cycle, is the ability to drive, rigorous underwriting, bespoke deal structuring, and really, looking at tighter covenants and better lender protections in the private markets. And I would also say, in terms of looking at a multi-asset approach within privates, you want to stay deployed with your capital in private funds, but you don't want to sacrifice deal quality. And so having a multi-asset approach within private credit allows, the portfolio manager to stay deployed, but do so without sacrificing quality and utilize the most active origination pipelines across their platform.
And then finally, you're not worried about all this action going on in private credit, in private market assets, in those alternatives, because I remember we used to like transparency. We used to like companies that reported, 4 times a year. Now it seems like everyone wants to do things privately.
Sure. So look, certainly going to be in the headlines, although I would call out some of the troubles we've seen recently have been actually more on the traditional bank side than necessarily the private credit side. But we're going to take our lumps as well. It's a new market, and so it's easy to shoot at. But again, I think what we're going to see over the cycle is that tighter sort of lending protections, the better covenants, and the ability to, in our case, we're the lead or sole underwriter for the vast majority of our deals. And so being able to work with borrowers through the cycle and able to, lower default rates, lower loss ratios while still delivering really attractive investor outcomes, we think that will prove itself over the course of, the next several years as we manage through the cycle.
All right. Well, thanks a lot for coming on and talking about it.
Yeah. Thanks a lot.